This is Dr. Ant.
All right, welcome everybody here to the session. Let me just turn this off here. My name's Rodrigo, and I'm going to be here with you today and with Mark Putrino, former hedge fund manager. He's traded with Steve Cohen, Mario Gabelli, multi-billionaires in the market, right? So Mark Putrino, lead trader from the Benzinga Trading School, 20 years of experience in Wall Street. And let's go ahead and bring on Mark Putrino here so that everybody can get ready. Big shout out there. Mark is in the house. Let's go.
Hey.
Hey, what's going on, Mark?
Had a pretty busy morning, session talk and all this. Had a good dinner last night in the city with a couple of our students. So it's going.
That's good. So as far as the class, I know there's a lot that's going on there. There's a lot of education. There's a lot of trade ideas. I know that you have something ready for everybody here. A great presentation. So if you don't mind, you can go ahead and share your screen here so that we can start sharing it to the folks.
Okay.
Yeah, you're all good now.
All right. Well, I guess thanks everyone for tuning in. Like Rodrigo said, my name's Mark. I teach the Benzinga Trading School, and I'm a good fit for this because I have a lot of really good experience in the trading world. So about 3 or 4 years ago, probably a little bit more, about 5 or 6 years ago, I decided I kind of wanted to get out of the money management industry because it's just changing. There's too much compliance and everything is becoming computerized, and it's not like a relationship game like it was back 25 years ago when I started. So I decided to come over here to Benzinga to teach people about my experience and how they can apply some of the stuff I learned to hopefully help them profit. So I started, let me just bring up the website here because I was actually looking at this the other day for a first time in a while. So this is the guy who hired me and brought me into the industry. So this is Mario Gabelli, right? He's one of the greatest money managers in like history. He was really big in telecommunications and cell phones. I remember him telling me one time that he was giving a talk about how cell phones were going to be the way of the future, and he had a phone that was like the size of like a shoebox. And this is like the early 80s or maybe the late 70s. And he told me by the end of the lecture, everyone had left because people thought it was like such a ridiculous idea to have but anyway, so I worked with some of these guys. He was there when I was there. This is like 25 years ago. But anyway, so this Mario is probably, not an exaggeration, probably the smartest person I've ever met in my life. And so anyway, he took me in, and I was lucky to trade there for 2 years. Then I made a jump over and worked with this other guy who is another Titan, Steve Cohen, who now is primarily running the Mets. Who we are, SAC Capital. Brings up the guilty plea. Anyway, that was well after I was there. But Steve Cohen is let's see, Steve. He is primarily owns the Mets now. But anyway, so this is Steve Cohen, Investopedia. So this money here, his $16 billion, I think it's a family office. So I think that's primarily his money. Most money managers manage money for other people. But anyway, so I was fortunate enough. It's like you take lessons from yeah, so it's like you take piano lessons from Mozart and Beethoven. So then after there, I went out and I was a head trader at 3 different institutional money managers where I was the head trader, where I oversaw the trading. So there really isn't too much in the trading world that I haven't seen. Oh, thank you, Jody Kim. That's very nice of you. I appreciate that. Let's see. I've been in the class since day 1. Oh, cool. Well, I'm glad you like it. Kim Possible. Okay, so anyway, where was I? I'm bragging about my background. All right, so yeah, so so Mario I met when I was at NYU in the business school, right? So then I was the head of trading at 3 different places where I oversaw a lot of different things, and then the last firm I was at got taken over by some guys that weren't very bright, and they destroyed the place. And then that's when I decided, you know what, I don't want to be in this money management industry anymore. Then one day I was just looking at some stuff online, and I saw some of this fraudulent advertising. I saw this newsletter that said, oh, the stock we recommended last week doubled. So I went to look at it. And for every stock, there's a bid and an offer, right? Like, look at this Sprouts Farms here. This is the bid and this is the offer. So right now, if you sold 100 shares, you'd probably get $27.42. And if you bought 100, you'd probably pay $27.44. Right. So I saw this advertisement where it was like, oh, we doubled our money, but it was really just a penny stock, and the bid was 1 cent and the offers were 2 cents. And, the stock hadn't really moved. I guess if someone sells 100 shares, it's going to be 1 cent, and then someone buys, it's going to be 2 cents. So it's doubled, but it hasn't really moved. So anyway, let me get into the school a little bit here, and I'll just give you a trading idea that we've just started talking about the other day, 2 or 3 days ago. Actually, right back here is this Walmart. So in the class or in the school, I teach what I think are the important market principles. Hello, Barnaby. The classes focus on principles. One of the principles of financial markets is that there are some price levels that are more important than others. That's just the way it is. You can see it on almost any chart. Another principle of financial markets is stocks that are oversold meaning they get really beaten down, and get to support tend to bounce a little bit. All right. So one class is we talk about price levels, another class we talk about momentum, and it all kind of ties together to be a practical trading idea. So Walmart reported the other day, and the market perceived it to be bad. They had a bunch of inventory buildup, which is a sign that things are slowing down. And anyway, so people sold it. Now look what happened. It got to a price level that was support in the past. For some reason, Brandy's talking about the profit. Cool, Brandy. Thank you. So this, you might have heard the term market memory. Well, this is what people are referring to. When you get to levels that had been important in the past, they tend to be important again. And sometimes these price levels can remain intact for a long time. I mean, I'm talking like months, maybe even years. So why is this important? Well, this is important because it's a way to approach the market as it's a trading philosophy, and it's a good way to approach the market. It doesn't have to be that complicated. A lot of beginner traders or retail traders, I think they think that the greats, like the guys like the Stevie Cohens or the Mario Gabellis, have like some secret formula or some secret system that they use. Oh, hello, buttery lobster. buttery lobster. Ooh. Sometimes I don't recognize some of you guys because you have different handles or different names in the chat. So I apologize. But anyway, let's go back to this here. So we looked at an important price level. We looked at something that was oversold, because oversold things that get to support tend to bounce. And sure enough, that's what happened. We had another little bit of a clue here too that kind of gave us a little bit of insight that we might bounce. Notice this really big volume here, right? This is 31 million shares traded. And this is a stock that on an average day trades about 9 million. So this is a really big volume. You can see the same kind of thing happen back here. And both times were followed by a bounce. Now, what is this? Well, people are watching this. They see the news. They get disgusted. And I'm talking more about like the big institutions. I guess it happens for retail people too. But they see the news. They say they have 1 million shares to sell. They sell some. They want to get a better price. They're hoping it comes back. It doesn't. Finally, they say, you know what? Enough of this. I'm just going to get out of here. Oh, Mr. Momo. Okay, Mr. Momo. Hey. So we had what we call this like selling kind of a capitulation here, right? And what happens is the sellers all get washed out. So when buyers start looking at the market and say, hey, maybe this Walmart news wasn't as bad as we first thought, and they come into the market to buy, there's no sellers around. The sellers have capitulated. So if you're a buyer, all of a sudden now you're going to have to say, well, I'm going to be willing to bid a premium to bring in a seller off of the sidelines. The stock might be at 123. They might say, well, I have to pay 124. There's just like a lack of sellers. There's more demand than there is supply, and that drives the price higher. So basic principles, right? Lesson number 2 is levels. Lesson number 3 is trends. Lesson number 4 is momentum. Just by combining those 3 things together, we were able to come up with a trading idea that worked out. I mean, it's not a guarantee. It doesn't work out all the time. But I want to convey the message that there's no secret formula that always works. The guys like Steve and Mario and other managers, Ray Dalio, whoever, Paul Tudor Jones, Jesse Livermore, the great traders, they lose money on a lot of trades. All right. People might be surprised to hear that, but it's true. The difference is they keep their losses small and they let their winners run. All right. That's the biggest mistake that traders make. I'm talking about traders now, not long-term buy and hold investors. The biggest mistake traders make is they hold on their losers for too long and they sell their winners too soon. And that's because people are affected by fear. That's why we have a class that we call investment psychology, where we talk about this stuff. Most people that don't do well because they make emotional mistakes. They guess. They have a system, but they don't stick to it. Hello, Jeannie. Seen a lot of Jeannie these days. I was just alluding to the fact that she's one of the students I had dinner with last night, and that was so good, man. It was this like high-end Greek restaurant. Who's the cousin of one of our students, is the chef there. All right, but anyway, let me go back to this now. Psychology, right? What would be a potential thing to do here? All right, well, I'm going to buy it at 118, and if it breaks this support, it's going to keep going lower. So I'll sell it at 117. I'll just take a 1 point loss. All right, that's what the great traders do. They're able to like say, all right, well, I'm just going to get out of this with a small loss, and I'm going to move on, and maybe it comes back, and I jump back in. But they keep their losses small. Now, another thing that they do is they let their winners run. So I would say if I was trading this, my target would probably be up around here, around 133. All right. But think about it. Someone buys it at 119, it goes to 120, 122, 23, 24, 25. A lot of people are going to be really drawn to getting to sell it because they're afraid that they're going to lose their profit. So they sell too early. So the great traders are the ones who can get out with small losses and let their winners run. This is something we talk about in the class a lot in our investment psychology class. The difference between day trading and the difference between paper trading and actual trading. Paper trading is relatively easy. It's pretty easy to create a model that's going to work on paper. The trouble is, once your emotions get involved, when you have real money on the line, it affects the way you think. So, like, just say on paper, you had a system that said buy 1,000 shares at 10 and sell it if it gets to 15, right? So you buy it at 10, you watch it go to 12, 13, 14, 15. And it's like, hey, this is easy. I'm going to sell it. I got a 50% gain here. All right. All right. That's on paper. Now, and you could say too, well, if it gets to 9, I'm going to blow it out and just take $1,000 loss. All right, great. Now, say you have real money. You put real $10,000 in that and the stock goes to 12. Now it's like, man, I got $2,000 here. I don't want to lose it. Maybe I'll just close out of my position early. I know my target is 115, but whatever. I'm going to close out here because I don't want to lose $2,000, right? Or on paper, it's easy to take a small loss, but in real life, you buy it at 10, it goes to 9. It's like, wow, I don't want to take $1,000 loss. Am I wrong? Am I an idiot? Like, what's going on here? So you can see the difference between real money and paper trading. So yeah, so you can see why real trading is much harder than paper trading because you have to get your emotions involved. That's really the secret. If there's like one secret to investing or this style of trading, if people said, say in one sentence what the biggest problem is, I would say that human beings have not evolved in a way that's conducive to managing money because we experience fear, the fear of losing money, the fear that keeps you from taking a small loss and the fear that makes you get out of your winners too soon. So that's one trade. I'll just show you guys a couple other things that we've done recently. Again, there's me. So I was market maker. There seems to be a lot of misinformation about what market makers do. And I can tell you with wholeheartedness that market makers do not go to work every day thinking, how am I going to rip off the little guy? That's not how it works. So most of what we do is based on technical analysis, right? Traditional technical analysis is looking in the market for trying to understand the supply and demand dynamics that are going on in a market. All right, I'm going to give I haven't used this analogy in a while, but I'm going to give it right now. So pretend it's the Middle Ages and there's this little village where everyone comes to trade there. All the farmers come to buy and sell their goods, right? It's like a little village market, like a little farmer's market kind of a thing. And now let's suppose there's only one road into town. Now, let's just say that a market or a merchant or maybe a shrewd investor goes and checks out the supply train that's coming in or the supply wagons. And they say to themselves, usually there's 10 cartloads of pears. I always say apples, but today I'm going to go with pears. But today there's only 1 cartload of pears. What's going on? Oh, there's going to be a shortage. The price is probably going to go higher. So that merchant runs back into town that merchant runs back into town and goes around and buys up all the pures, right? Then when the market opens and people want to buy pures, it's like you're going to have to pay a higher price, and this guy's going to turn around and sell it to you. So that's kind of what we do in the class. Is we try to profit from short-term supply and demand imbalances, right? We don't need to know about the pure industry. We don't need to know how pure trees grow, what style it is, or what type it is. We just see that, oh, something is out of balance here. And it's the same thing that we do in the market, right? We look for things that are out of balance. So some of our traders are swing traders, and we look at this SPY trade every day. Oh, hello, Adam. Thank you. This is the S&P 500. And when we saw that SPY broke the resistance at 390, we thought there was a good chance it was going to get up to 400. Yeah, Gene. Gene asks, this class is more about trading and less about long-term investing. Yeah, our main focus is trading, but we do look at some fundamental stuff sometimes. Like, for example, we've been looking at the retailers, if you look on their balance sheets, how the inventory has been building. And that's one of the things that kind of led us to think, well, gee, this GDP report that's coming in today is going to be negative, even though most people on the street thought it was going to be positive. So, every day is a little bit different. It depends on what's going on in the market. The first part of the class, we review the principles. Like, we talk about why are certain price levels important? What's the support level? What's the resistance level? Then we look into the actual market to see like what's going on in real time to see how if we can apply it. So here we were watching this resistance level, right? This 390 resistance. Resistance means there's a large group of sellers. There's a bunch of sellers that are trying to sell this around 390. All right. So when we get above that, we call that a breakout. And the reason why this is bullish is because it tells us that the sellers who created the resistance are gone. Maybe they finished their orders. Maybe they canceled their orders. Either way, when you take a lot of supply off of a market, then the demand side, the buyers have to be willing to pay higher prices. And that's what forces a price. That's what a market rally is. When there's not enough supply to fulfill all of the demand and the buyers have to pay higher prices, that makes the market rally. So we talked about buying this when we broke 393, right? Or when we got to 393 because it broke the resistance. And our selling price was up here around 400. And this is another important level too. It goes back to here. Think about this. The market got crushed this day. And a lot of volume trades, most volume trades on the open or the close. So a lot of people bought this ETF, and they thought, oh, I'm bottom fishing here. I got it right at the low of the day. Then the next day it goes lower. So a lot of these people that bought it, they experience buyer's remorse. And a lot of them tell themselves, hey, I made a mistake. I want to get out of this, but I don't want to lose money. So what I'm going to do is I'm going to try to sell it at the same price that I bought it at. In this case, it would be around 400. So that was a reason for our target to be right up there. So this is just a short little couple day trade. And some of the students are trading options. Some of them might be trading leveraged ETFs. This is kind of just like our guideline of the market. This is like the most broad benchmark. So just by understanding supply and demand, it allows you to make a profit, right? This is like the merchant coming in buying the pairs when all of a sudden he sees, oh, all these sellers are off the market now. The demand's going to drive the price higher. Thank you, Buttery. I'm having a hard time speaking today. Buttery lobster. I haven't even had lunch yet. All right, so now we can take this to the real market, and because that was from a few days ago. And now we're breaking out. See how yesterday we got up to the 401 level? Same as like back here, and that's where we hit resistance. So I tell the students either today or tomorrow, I think that SPY will continue to move ahead and get up to around 408. And that's where it's going to take a break. And the reason why I'm saying that is because 408 was a support level. So levels that were support can turn into resistance. Let me show you some really good examples of that. I'm going to go look at our technology sector. And by understanding this, it is the key to successful trading. Like if you don't understand how to interpret these charts, I can't fathom someone being a successful trader if they're not looking at charts and understanding them. And too many people get caught up with like, oh, is it this pattern? Is it that pattern? We don't need to do that. What we just want to focus on is what are we seeing about supply and demand dynamics, right? Because this is where we pick our targets. Like, all right, well, just look at this first. Support becomes resistance, right? People buy, it goes lower, they regret buying, they try to get out at the same level they bought at. If there's enough of these sell orders, the level that was support can convert into resistance. See, in the institutional world, no one's doing like some of this crazy esoteric stuff like you might have heard of, like Gann theory or Elliott wave and stuff like that. I mean, if you guys can make money on that stuff, that's great. This class is based on my experiences in the institutional world. And in the institutional world, no one looks at stuff like that. This is what we look at. Oh, what price level is important? It doesn't have to be that complicated. So, for example, say you bought XLK here and it started to rally and you started to think, where should I sell it? Oh, a former support level. There's a good chance there's going to be resistance there. So maybe I'll sell it a little bit below. Say you bought it here at 150 and you say, you know what? I'm going to sell it if it gets to 170 because you just randomly picked a number out of the air. You don't have a good understanding of how to look at charts yet. All right. Guess what happens? It goes up and it hits resistance and it goes down. And now you just missed out on a nice profit because you didn't understand the dynamics of how certain price levels are more important than others. So you could have bought it at 150 and sold it at, say, 163. It's not as good as selling it at 170, obviously, but it's better than missing it. All right. So institutional traders, we look at price levels that are important. We look at the momentum. We look at our trends. But we can see here, support becomes resistance. Support here becomes resistance. Support here became resistance there. So it's based on common sense, right? Logic, experience, just understanding these principles, price levels, momentum. That's the key to being successful. Today's class was actually about trading models and how we can use these indicators to build trading models. But let me just kind of hit you. Brandy says the SPY levels are what has really. Yeah. Yeah, it's pretty wild, man, because I mean, I guess because I'm kind of a chart geek, I think about this stuff, but this is a market of billions of dollars with, I don't know, hundreds of thousands, if not millions of people trading it. And somehow it manifests itself in these like perfect, almost perfect, like Brandy alluded to, these like, how does something so precise become so precise? When I was in business school, and I think they probably still teach it, we learned about the efficient market theory, the random walk. Hello, Q Antum. The random walk theory. Well, if random walk was true, then you would not have some price levels being more important than others. And you don't need to be a market guru or some big shot, hedge fund trader to see, oh, wow, certain price levels are more important than others. I can see it here. And I think that, yes, we are in a recession. And I think that now they're even talking about raising taxes, which is just going to make things worse. It's really just hard to believe how incompetent some of these people are. All right, what do we got here? Oh, this is the one that I talked with Ronnie about. so day trading, right? So this is a lot of our students are day traders. And when you're day trading, you pay attention to the same thing. Where is the support and where is the demand? So one of our students asked me, and she's actually she's very good. She's picked it up really rapidly. But she's a short-term trader, and it looked like this was going to go down. Okay. Because what happened was it got up to here, right? This day was here on July 17th. It got here and it hit resistance. Former tops can be resistance. That makes this an important price level. So it stalled out at resistance and then it went lower. And at the close where the buy was entered, it was at a level that had been important. These blue candles are days where the market is up. The closing price is higher than the opening price, and the red candles are the opposite. So on this particular day, it rallied, and this was the close. Then we got up here to resistance. When it looked like it was going to fail at the resistance, fail means that's like trader talk for saying something's not going to get through resistance. It fails. When something gets to resistance and fails, that brings sellers into the market that are momentum type traders. And where did it find a bottom? Right at the level that was the close on this day, the low on this day. And obviously it's gone higher, but this was just a day trade. So we have a lot of day trading students. I think we have people that aren't trading yet. They're just trying to learn. And that's good because they don't have to unlearn things. That's why I think, there's a lot of people that I've seen that, like aren't in the industry, but they're intelligent. And because they don't have to unlearn stuff, they've been successful, right? It's like, if you don't want to, it's easier to start from scratch than it is to unlearn things. But if you're having problems trading, you can come to the school and we will try to unteach you some of the things that you might think are wrong. All right, what else did I put in here? Oh, okay. So this is our natural gas. All right. So a bunch of the students they don't trade commodities. Well, I guess some of them probably do, but there are ETFs that are designed to give exposure to commodities markets. So we've done some really good trading here on in the natural gas world. So buy because of a breakout, right? We break above resistance. The sell target is up here, a former support level. So people can buy an ETF that's UNG, which is designed to track the price of natural gas. So you can buy it just like a regular stock. So, don't think like, oh, gee, I don't trade futures. I don't trade natural gas. This class isn't for me. There are ETFs that we can use to pretty much trade almost anything. A lot of the students, I think, are surprised, and a lot of people, even some professional people, I find, are surprised when they learn that there's all these inverse ETFs out there. Like a lot of the mantra going on in January and February and March was like, oh, go to cash, go to cash, go to cash. But if you think the market's going to go lower, instead of going to cash, you can go buy an ETF that goes up if the market goes down. So a lot of times it's easier to make money on the short side or if the market goes down because markets go down faster than they go up. So part of being a trader is learning how to, make money, obviously, but it's not just about the trading and the styles and the methods. It's about understanding how to gain exposure to things. If you think the market's going to go down and you're right, you can buy an ETF that's designed to go higher. If you're someone who's more aggressive, you can buy a leveraged ETF, something that is designed to go up 3 times as much as the market goes down. So in other words, if the market goes down 1%, this particular ETF would be up 3%. If you're like a super aggressive style, and I know some of our students are, you could buy options on the levered ETFs. So a couple of the students had said that over, let's see what period it was, they had some of the best trading days of their entire careers. And that was right in here, right? So we saw that we were failing, right, at a former support level, because there's resistance at former support levels, but there tends to be. When it looked like we were breaking out of this trading range here to the downside, a lot of the momentum traders came into this, right? So this is where a lot of the students were buying some of these inverse ETFs. So like, let's just look at this particular day here, June 9th. This was down 2.7%. This is one of the instruments we can use. All right, so June 9th, this is up 8%. All right, so if we saw the support breaking. So the question is, if support's breaking, well, what do? Do you short it? Do you buy puts? Do you go into an inverse market like this? The answer is it all depends on what's your style and what fits your personality. There's no one size fits all thing. That's why I guess from a point of interest, maybe it would be interesting for people that are just getting in this to like watch like how people trade and so forth. But you got to do something that fits your personality. Some people like to day trade, like they're high energy. They like to look at the markets all day. They can look at the markets all day. Maybe they work from home. Yeah, Jeff. So that's what we're doing. Yeah. So Boyle and Cold are two of the ETFs we use for natural gas. So there's always opportunity somewhere. It's just about learning, how to find them. And that's one of the things that we do. So anyway, I believe, I'm not 100% sure, but I believe a couple of the students bought call options on this as we saw the XLK break down. So trading is understanding trading styles, right? It's also understanding how to gain exposure to different things. It's also about understanding your risk management and how you allocate your capital. Like if you're right on the direct, like you say, all right, I think the market's going to go up, and you're right. Well, there's a lot of different ways you can play it. Are you just going to buy stocks? Are you going to buy options? Are you going to buy ETFs? Part of trading is figuring out how to get the best bang for your buck, so to speak. Like what's the most efficient use of your capital? And that is something that ends up just being someone's personal decision based on their personality and their time frame and their risk tolerance. Some people, so a lot of it's based on your risk tolerance and how aggressive you want to be. So some people are meant to be day traders. Some people, maybe they want to be a day trader, but they don't have access to a computer because they have to work. So then a day trading style probably isn't going to work for you. Some students are swing traders, and that's really just a term for short term, but more than a day. So you get into a position for a week or a couple of weeks. But we do look at earnings too. We do look at some fundamentals, like when we have companies like FedEx or UPS or some of the trucking companies, we can get good insight into that. By going through companies like that's earnings, we can get some good insight into what's going on in other parts of the economy, right? Like we did a trade, Born to Be left, but I think he was in this one. This Tyson Food, right? Going back to here. So this is February, and this thing blasted off, and this actually ended up being a profitable trade. A bunch of the students bought puts on this. But anyway, the stock, it blasted off here on earnings, all right? So we went into the earnings, and as it turns out, the earnings weren't as good as they appeared to be on first glance. I forget exactly what they are now, but I think it was like the estimates were like 205 or something, and they came in at like 290. But going through the earnings report or going through the earnings presentation, we quickly deduced that these earnings aren't as good as they appear. The only reason why the company did so well is because they had to raise their prices. Why do they have to raise their prices? They had to raise their prices because of inflation. The stuff that they need to feed their chickens, like I guess corn or whatever it is that chickens eat, the prices moved much higher. So the numbers weren't really as good as they seemed at first glance. So we started watching this for a potential trade. And when this short-term support level broke here, this is where a bunch of them got in. And this is where we got out. All right. Levels that were resistance can become support. And this is the opposite. This is because of seller's remorse. People sell. It's not the opposite of buyer's remorse. People sell, and then it goes higher. A lot of them regret buying. So they tell them are selling. So they tell themselves, I'm going to buy it back if it gets back to my price. So our sell was triggered by a break. I'm sorry, our buy was triggered by the break of this level, and the position was covered when we got down to here. So, I mean, you can see it went even farther, but we had a really good trade, and it's more about making money than being right or being precise. Oh, hello, Juliet Lupo. That's good. Nice to hear. Thank you.
Right, good stuff there, Mark. And we're getting a lot of emails and questions here about the trading school. So I'm just going to go over these really quick here, Mark. And then we can
I'm going to take I'm going to take a 2-minute break. So.
All right, sounds good. And folks, so basically for the trading school, keep in mind we do have the link there. So it's pretty much a semester roll. So every 3 months, it's $4.97. You get access to Benzinga Pro, to the live classes. Let me go ahead and show you this really quick here before Mark, once he gets back here. So this is the dashboard, right? You have access to your schedule here, Wednesday, Thursday, what's going on, throughout the week, what chapters you're looking at. Classes are at 7 to 9 a.m. Eastern, and then all the way from 12 to 1 p.m. So the video library, this is a perfect place if you do want to watch the recordings. If you missed the class, maybe you have a full-time job, you can't attend the live sessions. You have all of the recordings there with the Q&As as well. The other thing that you have are the live trading rooms and the live rooms here in the chat section, everything in the header. You'll have several here questions for Mark, student charts of the day, class files where you'll be able to find quizzes that Mark is posting there. Again, these are comprehensive quizzes that will help you basically see where you need more work on, and that way you can have a little bit more of a hands-on approach, right? If you want to succeed in this. You get access to Benzinga Pro. Again, you just click there. It takes you right there. It opens. It loads up. You're good to go. It'll take you there, and you can start doing all your searching, trade analysis, watch list, all that stuff. And yes, Mark Putrino does keep it simple. So question about the schedule, we kind of went over it. So Monday to Thursday, it's 7 to 9 a.m. and then 12 to 1 p.m. That's the schedule. Next question, do you get the recordings? Yes, we went over that right there in the video library. Good question there, Phil. Next question, how long do we have access to Benzinga Pro if we have the school? So as long as you have the trading school, you will have Benzinga Pro. So every 3 months, it's $4.97. So basically, it's pretty much on a semester basis where you per 3 months and such forth. And it will pretty much be the same price. It's always going to stay the same. And let's go ahead. And now that we showed you this really quick, let's go ahead. I believe that Mark's back here in the building. I do want to give a very quick shout out because we do have a new face here, a new member that just joined the trading school. And of course, we do want to give them the proper introduction here. So let's go ahead and welcome TWR21 I'm not going to say the full email, but TRW, welcome to the family here, my friend. Let's go. All right, so let's go ahead and carry on here with the lesson, Mark. I know you had some things here you wanted to go over, but yeah, we went over some of the questions that the students had. Well, some of the viewers had as far as the schedule, where they can find the trade ideas, where they can find the recordings. And I know that you do have also a set. What is it? It's one of these. Well, you do it I think it's every Friday. It's once a week where you do like a week summary, right?
It's actually for Monday morning.
Yeah, can you go over what that is, just so the people that are joining here can get a sense of where to look for it and all that stuff?
Sure. Okay. I'm just reading Jeff's comment about Amaranth. Yeah, they were a big hedge fund. I actually worked right across the street from them in Greenwich there. So yeah, a lot of people think that, like, just because you're on, these Wall Street people like are, these gurus and so forth. But let me tell you something, man, there's a lot of stupid people managing money. I mean, some of it's because nepotism, it's their parents' firm, or, you know, I mean, like at Amaranth, basically what they did is they put all their eggs in one basket, and then then it went against them. So it's unfortunate because the firms blow up because the senior people make dumb decisions, and then all the minor people end up losing their jobs and so forth. So anyway, yes, I remember Amaranth quite well. And ironically enough, they were in the same office complex that Long-Term Capital was in, which blew up, however many years before that. So I guess maybe there's just something with that that office complex is not good for money management. Anyway, I want to show you this other trade we did here. This is more of a longer term thing. All right. This goes back to January, right? So I've been talking about inflation since August of 20. In a previous place I was at, I was writing about it back then. So I don't know for the life of me how these people didn't understand that we were in an inflationary environment. I guess they don't have charts down there at the Federal Reserve. But anyway, we think that there are certain websites that we check out that are informative, that are free, that are unbiased. And one of them is this. Okay, if you might have heard like the PMI, Purchasing Managers Index. That comes from this. This is the Manufacturing Purchaser Index. So this comes out once a month. It's the first day of the month, or I think the first business day. And we look at it, and it gives a lot of insight into the broader economy. Now, this is June, right? We were on what I'm going to be referencing is that the one that was in like December. But you go through here, and you can kind of see what respondents are saying. You can see here commodities reported up and in short supply. Commodities down in price. Now, when we were looking at these reports in like November and December, there was not a single commodity that was down in price. Every single one of them was up. So what does that mean? Well, it means there's inflation. So how do we profit from inflation? Well, one way is we could buy an ETF that tracks the commodities index. So we first started talking about this here, and I know a lot of the students got in around here. And then this is where Ukraine happened. Then when we broke our uptrend line, this is where we sold it. So that's a pretty good return. It's almost 50% in a matter of like 6 months. But this came not out of like some secret system or listening to some guru on CNBC. Just by looking at this report, it was obvious, that we had inflation. When every single commodity is up and there's not a single one down, you don't need to be an economic guru to be like, oh, gee, maybe prices are going up. So if the prices are going up, what does that mean? It means the prices are going up. What is inflation? And prices are going up. So anyway, my point is that there's a bunch of these free websites that we look at that we can get some good insight into. And the good thing about these things is that these aren't biased. This isn't like someone's opinion. This is really just data. So that's another way we come up with some of our investing ideas. All right, let's take a look at a couple more of them. Oh, let me show you guys this too, because I'm actually quite proud of this. I'm a big history buff for United States history. And I think if you're in the market, if you're a trader, it really helps to understand history because things repeat. All right. Things repeat. People change, the names change, the companies change, but human nature doesn't change. So this particular one, and I'll just kind of show you this. This I did. We do a little bit of a review of what's going on in the market, right? I put in like, I don't know, maybe 7 or 10 charts that we should look at. And then this week's lesson was on Andrew Carnegie. gives a little bit of his, this is him, obviously. I like his desk. I would love to have a desk like that. Everything's so minimalistic now. But anyway, so I think it's important to learn about history because it helps us understand things in the market in the current day. And then we're talking about the S&P, and we talked about the tech sector a little bit more. Andrew Carnegie here talking about the Homestead strike, which was at a plant that he owned. The workers went on strike, and back then things were different than they are now. They actually brought in the union busters, and there was like a big riot where I think 10 people died. But anyway, he was over in Scotland playing golf, and he had this other guy running his company. This guy named, he says in this jerk, Henry Frick, right? He's the one who messed up. But anyway, it was Carnegie's company. And of course, this is back before they had cell phones, so it probably took them a while to get him the message. I would guess a guy as rich as him would probably have had a telegraph or something. So a little bit more about the market. This is more about the Homestead strike here. Oh yeah. This isn't stuff I write. This is just copied and pasted. I write this stuff. This is stuff I just copy and paste from various historical websites. And then here is Henry Frick. So, and here is Carnegie again. And then when I actually learned something when I was doing this, I knew he was a philanthropist, but I didn't realize to what degree he was a philanthropist. And in this here, and I've put in all these little things because I just want to kind of convey how much he did. But this dude did everything, man. He was donating to colleges, and he was ahead of his time with civil rights. And obviously there's Carnegie Hall, there's Carnegie Mellon. So towards the end of his life, he was a really impressive man. I mean, I guess he was an impressive man his whole life. So anyway, every week I try to do a little bit of a history lesson here with a little bit of satire. So he was like really close with his mother. He lived with her until he was 51, and she wouldn't let him marry this woman. So when she died, then he got married. So I like doing I'm a history buff, but I think understanding history helps you understand what's going on in the market now. All right. Like this whole talk about inflation, deflation, that's been going on since the beginning of the country. They used to call it hard money or soft money. And I'll just show you the one we did. This one we did here too. Right. So I think this is kind of interesting, and you could, take it for what it is. Right. So Thomas Jefferson, obviously considered a great president. After, in the early 1800s, there was a war going on between Britain and England, and the British ships between Britain and France, and the British ships would board a lot of the American ships, saying, "Oh, you're bringing stuff to France," and they would impress their sailors. I mean, they would basically take their sailors and make them go work for the British Navy. So Jefferson's response to this was, "Oh, we're just not going to trade with any other countries." It's called the Embargo Act, and without, you don't need to be an economic genius to know that without trade, the country is going to go into turmoil. And they ended up having it ended up causing a lot of strife because they didn't understand business, right? And now you could even argue that what's going on with our energy policy now. It's like how could Thomas Jefferson just say, "Oh, let's never trade with any other country," and think that it's going to be okay? All right. Well, anyway, hopefully you guys will enjoy it if you come into the class. Yeah, sometimes some of my Wall Street stories come out. Art Cashin is very helpful. The Pinkertons, all right. Carnegie Libraries. And, it wasn't just here. He did stuff over in Scotland, too, where he was from.
Right. There's definitely some interesting stuff there, Mark. Quick question here, because I do know that this is something you definitely, you talk a lot about on the school. But my personal class, the most favorite one, is the investment psychology class. I think that if that is not in the right place, if that mindset is not there, right, the strategy, the discipline, so many other things, right, fear, greed, up, so many things in play. If the psychology of it is not there, nothing will work, right? So that's why you really emphasize. You have a whole chapter on it here, right?
Yeah, we have a whole class on it because that's the real reason why people have a hard time trading is because they let their emotions, they make emotional decisions. And it's not, it's not just in trading, but in every area of life. If you make emotional decisions, they might not be so good. And also, too, it's important to understand how much you are influenced by stuff that is going on around you. Like you might think your thoughts are your own, but a lot of times they're not. All right. Think about fashion. Like, why am I wearing a baseball hat, a Benzinga baseball hat, right? These things weren't fashion. Baseball hats weren't fashionable 100 years ago. People wore fedoras or whatever those hats are called. Like, why do people wear suits? Why do you accept the fact that a suit looks good or a dress looks good or it's fashionable? Well, because you're responding to external stimuli, right? So think about this. Think about this, right? You're driving down the highway and you come up to a toll booth and there's like 15 different lanes and there's 30 cars going into one lane, and your instinct is to just pull up in the back of the line there. That's what most people would do because they're not thinking. If they think on their own, as opposed to being influenced by the environment, they could look up around and say, hey, lane number 4 has got a green light and there's no one there. I'm going to go drive through that. And you just drive through and then you look in your mirror and you see other people coming. So I worked in the city for a long time, and I would take Grand Central's train on Grand Central because I lived in Connecticut. And every day, I would get to the train after work about 4:30 or so, and the people would be piling into the first car, and there would be no seats. People would be complaining to the conductor. People are like, getting annoyed because someone comes and sits next to them. If you just walked around the crowd and went up to the front of the train, you could have the whole car to yourself almost, right? And I used to think every day that as long as people keep doing this, people like myself and like yourselves are going to be able to make money in the market because we're going to be trading, we're going to be taking advantage of the fact that people are illogical and they're driven by emotions. So this is one of the things that we talk about in the investment psychology class. And I will tell you this, when I was working for Steve Cohn, there was a full-time I don't know if he's a psychiatrist or a psychologist on the staff there, right? So, and then I'll tell you this too. When I worked there, Steve gave an interview to the Wall Street Journal, and I mean it was a long time ago, but I believe it was only the second interview he had ever given, and at the time he wasn't a household name like he is now. Now I guess he's most famous for owning the Mets. But one time he gave this interview to the Journal, and it's on the trading desk, and we're all listening in our headphones because he's got a microphone up there, and he gives instructions to all the various traders around the room what to do or whatever. So we could listen to the whole thing, and the person that was interviewing him was really like trying to figure him out, like, oh, do you use a DeMark system? Do you use moving averages? Do you use this? Do you use that? And I distinctly remember Steve saying, he's like, look, I'm telling you, all of those things could work if you have the right emotional discipline, and that's what goes back to what we were talking about when we first started, how people get afraid of losing their profits. So they sell their winners too soon and they hold on to their losers for too long. And a lot of people are surprised to find out that some of these great traders, some of them might even lose money on more trades than they make money on, but they keep their losses really small, right? I mean, you think about it, you could theoretically have 100 small losses and then have one huge gain that actually offsets all those losses and then some. Why don't men wear suits to ties to work anymore? Well, I guess it's just fashion, I mean, I hated wearing suits, but I did. Most of my jobs I had to wear a suit, at least when I first started out. But things come in and out of fashion. I'll give you kind of another interesting little historical story. Danbury, Connecticut, which is about 45 minutes from where I am, was the hat capital of the world. They made hats. To this day, their football team is called the Mad Hatters, right? So it was the hat capital of the world. Then, in whatever year it was where John F. Kennedy got elected president, when he was doing the walk up the road there on Inauguration Day, he wasn't wearing a hat. So overnight, hats went out of style, and that decimated the economy of Danbury. And I think it's still pretty, most parts of it are still pretty ghetto. But yeah, I mean, it's weird. Like fashion comes in. Think about this too. Like if you're a sports fan and you're in a bar getting ready to watch, your favorite football team play, and someone comes in and they're wearing a jersey of your team, and it's like, hey, you feel like this like automatic bond with a person, right? And this goes back to our human instincts. There's safety in numbers. That's why I think people get sucked up into the herd mentality, and that could be very dangerous because you could get into some chat room and everyone's talking about, oh, you should buy this, you should buy this, you should buy this, and you get sucked into the herd mentality and you stop thinking on your own. So psychology is a big part of it. Yeah, Brooks Brothers is out of business. I'd be pretty stoked if they Jeff Strong, I was at Chase One Tower, which is a block from Wall Street. After the market closed, all those people disappeared. Yeah, well, it's trading is very stressful, right? And the analysts always it's like it goes on like every firm. It's like the analysts bitch because they gotta like stay late, and the traders are all 4:30. They're all at the bar, But here's the thing. First of all, traders you can't go out to lunch. You got to eat lunch at the trading desk. Traders generally get into work like 6:30, 7 in the morning. And, here's the thing. Like I used to say this to some of the analysts, right? Like, if they're complaining, like, why does market leave early? And I would say, hey, dude, let me tell you something. I can make a mistake that makes this firm go out of business, So I'm under a lot of intensity for 8 hours a day. You can go out for a walk. You can do this. You can do that. Thank you, Gene Bond. Being a trader is a lot, I think, like being a pilot in the institutional trading world, in the sense that a lot of times you're bored. There's not much going on. It's like, you're reading the New York Post, maybe putting some golf balls around, and then all of a sudden all hell could break loose. Some bad news comes out on one of your stocks or something. So it's really stressful because you literally could make, if you're a trader, I mean, you literally could press the wrong button. And I mean, think about this, right? Say you have an order to buy 100,000 shares of something, and you accidentally type in an extra zero and you buy 1 million shares. Now you have 900,000 shares of a stock that you don't need or you don't want. It's like, what am I going to do with this 900,000 shares? Well, you got to go and sell it. And you're going to have a massive loss. If you sell it down a point, it's a $900,000 loss. So that's some of the stuff we talk about in the market or in the class. It's just kind of really what goes on day to day in the actual market. I don't just like teaching about the trading. I like dispelling some of the myths that are out there. But let's look at another trade. All right, so we looked at the natural gas trade. We looked at the day trade there. All right, here's another trade that we did that worked out, and it's based on just on our pure levels. It was to buy AMD when it got to support and sell it when it got to a level that had been support in the past. So let me bring that up on an actual chart here. This is what we refer to as market memory. These levels can remain intact. An important level can retain its importance for a long time. As a matter of fact, you would probably be shocked. There are levels that we can point out that have been important for years. I mean, look at this right here. This is advanced micro devices. There's support at 73.50. It got back here in September of 20, found support. October of 20, March of 21, May of 21, and early July. So this turned out to be a profitable trade, not from some incredibly complicated model. This came because of just understanding the basic, just the basic things of what is an important level. Right now, it got a little bit above it, but still, though, the trade is to buy it here and sell it here. So you make a few points in just a matter of days, and some people, I guess, were probably trading the options on it. So it doesn't really need to be that complicated. If you just focus on these fundamentals that I try to teach, like what are the levels, what are, the psychology and so forth. Think about this. A lot of people, especially people that are more mathematically inclined, like I see this with a lot of engineers, they, they try to figure everything out like mathematically, right? But this is not, like I talked about before, the chess game, right? People are irrational, and you got to remember that all of this is people interacting. Like right up here, someone was buying and someone was selling. It turns out that the seller was right and the buyer was wrong. But we have, there's been probably about 5 years ago, all this AI or artificial intelligence started coming to all these funds, and everyone's like, oh, AI, blah blah blah, AI. And so if you had a hedge fund and you were trying to raise money and you had some kind of AI strategy, it was an easy way to raise money. They had people from NASA and PhDs and physicists. And guess what? The performance of those funds has really been bad. As far as I know, I don't know of anyone that have done well. And that's because you can't figure out the market with math. You got to understand that this is human reaction. Like we saw how support can turn to resistance because of buyer's remorse. That's a human reaction. Resistance can turn to support from seller's remorse. All right, now I've lost my train of thought. All right, yeah. So, I've spoke to it so much today, I forgot like who I said to what, or what I said to who. I guess I should say that the other way around. What I said to who. But yeah, so I see that with like a lot of mathematical people or people that tend to be engineers. They think that they can come up with some mathematical system that works, and the reality is, it doesn't, because they try to. You have to understand that this is irrationality here. AMD is up 1% today. Like, what has happened in this company that's worth 147 billion that's made it gain 1% in value? And the answer is probably nothing other than investor perceptions. So this is all psychology. I mean, yeah, sometimes news comes out that's impactful or whatever, but why was this stock up on May 13th? Why was it up 9.2%? I don't know, because people were buying it. That's why. Why did people sell it on May 12th at 86, and then people the next day, May 13th, were buying it at 95? It's illogic. It's human emotion. This is a study of supply and demand dynamics and also mass psychology. So I think that's a better mindset. Is kind of like if you're a poker player, right? You're going to be playing someone on the other side of the table, and that person has emotions. So what they do today might not work tomorrow, and vice versa. So that goes back to our whole psychology thing. If you try to figure all this out with just logic, you'll drive yourself crazy. And this is why I tell people, like, don't watch CNBC or shut all that stuff off, because they try to assign every single little move to some kind of really like fundamental reason. And the vast majority of the time when the market's moving, it's just random noise. It's just random order flow. Money's coming in, coming out. Like if you put on CNBC or Fox Business or one of these places, every single move, it's like, oh, I don't know. It's like, what's his face? The senator Joe Manchin, right? It's like, oh, Joe Manchin just sneezed and the market liked it. It's up. It just went up 30 points or whatever. And it kind of annoys me because I think it teaches people erroneous things. And in the real trading world, the institutional trading world, no one is really sitting around saying, "Oh, so and so said this, let's go buy." These people have strategies that, like if you're a traditional buy and hold manager and you spend all this time doing research and you buy maybe 30 different companies, you have the stocks of 30 different companies, like you're not going to be reacting to what they're saying on TV because it's like you've done all your research and you're confident that you're in the right stocks. So I guess it's unfortunate, but it is, as they say, it is what it is. So with me, because I have such an let me start it from a different way. When I first started to consider doing this class, I looked at a lot of these other trading classes, and I mean they're pretty bad, man. They're pretty bad. I don't think I saw a single person other than some of my colleagues over here at Benzinga um, that I was like, wow, like a lot of these people, they have these trading schools, but it's someone who is successful for 5 years in a 10-year bull market. They've never been in a bad market, right? So, when the market's going up, everyone's a genius, and when the market's going down, it's not as easy, and that's what we're seeing now. Like some of these other places, trading schools have had to pay fines for misleading advertising and so forth. There was like that Raging Bull or whatever they were called. So, I mean, maybe some of the people, they mean well, but they just don't have the experience that someone like I have. I mean, I've been doing this for a long time. The strategies I've overseen, like when I was a head trader at this place that unfortunately went out of business, Lombardia Capital. I mean, we were trading currencies and we were trading options and we were trading commodities, and we had boring strategies or just buy and hold. We had exciting strategies like long, short. And when we talk about a hedge fund, right, you have to understand that there are what we call institutional money managers, right? And that's where I worked. I was a head trader at 3 different institutional money managers. The money managers could have different products, right? Like, for example, they could have a mutual fund that they have for retail investors. They could have my daughter's texting me an image of I think a guinea pig she wants to adopt. But anyway, all right. So within one institutional money manager, there might be 5 different hedge funds, and there might be 3 different mutual funds, and then there might be institutional money management as well, right? Traditional institutional money management. The difference between a hedge fund and, say, a mutual fund really comes down to the fee structure and who can invest in it. You have to be what's called an accredited investor to invest in a hedge fund. But the reason why these hedge fund guys make so much money is because of this fee structure, right? They're not trading their money. They're trading their clients' money. Their clients are places like pension plans. If you have a pension, it might be being part of it might be being managed by some hedge fund somewhere, and you might not even know it. So the hedge funds, they get a piece of the action. So this is how these guys get so rich, because they're managing other people's money and they get a fee. So say their fee is a 2% management fee, and then they get 20% of the action, and they raise $1 billion, and they have a return of 50%. Well, they get to keep $100 million. That's their $20 million performance fee. So that's where all this money comes from. And there's this whole thing too. I'm kind of into exposing this whole myth of like the little guy versus the big guy. The big guy's out to take advantage of the little guy. The way it works is we're managing money in a hedge fund or an institution, which ultimately is the little guy. Our 2 biggest clients at my last firm were a church endowment and a pension plan, a teacher's pension plan. So the institutional world, the big guy is actually managing money for the little guy in a lot of cases. Fat finger mistake. Yeah, I remember that. I don't. I've heard Renaissance wasn't doing that good, Mark G. I don't really know the. Yeah. Um. Yeah. So it's so and now let's talk about what a market maker is. Okay. There in on Wall Street, there's what we call the buy side and the sell side, and it has nothing to do with buying and selling. So it's a little confusing. It's just slang. I don't know where it came from, but the buy side is the part of the market that the people that have to pay a commission to get a trade done. So it could be a hedge fund, it could be a retail investor like yourself. You need to pay a broker to execute your trade. That's just the law. All right. So that's the buy side. We have our hedge funds, our pension plans, money managers. The broker dealers is what we call the sell side. They're the people that get a commission to execute a trade. So at the broker dealers, they have people that specialize in trading particular stocks, and those people are called market makers. They're like someone might be, say, a utility stock market maker. They make markets in utilities. All right. So I'm the hedge fund. Say I want to buy I want to buy 1 million shares of some utility stock. I call up Goldman Sachs and I say, hey, I'm looking to do something on this particular stock. And people don't like to show their hand. It's like, you don't want to go and tell them, oh, hey, I'm a seller, because maybe that information gets out and it affects your order or whatever. So I would, someone like me would probably even get on the phone with the market maker and say, hey, dude, I got something to do here. And they're like, what are you doing? Let's just go to XLU. And they're going to try to find out what I'm doing. They're going to try to, fish it out of me. Oh, wow, that's a pretty nice break there. They're going to try to fish it out of me. Like, what are you doing? Are you a buyer or are you a seller? Well, I probably don't want them to know. So what I would say is, all right, make me a market on 1 million shares. So let's just say it's this. So they could come back and say, I will sell you 1 million shares at 75. I will buy 1 million shares at 71. They just made a market. That's where the term market maker comes from. So these market makers are not going to work every day thinking, oh, gee, how can I go rip off the little guy? They're thinking about doing a good job for their clients, who are the people like me, the hedge fund guys. And we're trying to do a good job for our clients, who are basically pension plans and endowments and stuff like that, the little guy. So that's really kind of how Wall Street works. All right, Brandy, see you tomorrow. Yeah, Bloomberg is like 25 grand now. So, I mean, Bloomberg it's a great thing, but like 99% of the stuff you can get in there, like you probably don't need, but you can pretty much get everything. So yeah, I used to, my entire career I had Bloombergs. So anyway, so that's what the term market maker is. That's where it comes from. So, the utilities market maker, they're just going to specialize in the utility stocks, for hypothetically. So let's just see. Some stocks are so active, like Apple. There's probably market makers that's all they trade is Apple. I'm a little bit removed from the institutional trading world these days, but I know that back in the 90s when I was an over-the-counter trader, some of the really busy stuff, like Intel, Microsoft, some of the big firms, they would have a team of like 10 people. That's all they did was trade Microsoft because there was so much volume in it. So these are utility stocks here, right? This is the utilities ETF, and these are the holdings in it. So the person who's the utility market maker is going to know all these stocks inside and out. They're going to know that. They're going to know the news. They're going to know who's reported earnings. They might even know the management of the company. So that's what a market maker is. Mark, followed your lessons from class, and Walmart worked out like a charm. Thank you. Yeah, let me just go back and review Walmart because I know that there's more people here now than there were before, and just talk about how we can make a trade based on common sense and basic market principles that don't need to be that complicated. So we have a stock that got to an important level, a support level, right? We reported earnings, it got down here. We had a big amount of volume trade, and that told us that there was a good chance that this was going to go higher. And certainly, and sure enough, that's what happened. Constitution of axioms. Yeah, Bloomberg, man, they don't make any deals either. Like, it's not like you could, if you say like, all right, if we get 10 Bloombergs, can we get a price discount? And they're like, no. If you have 100 Bloombergs or you have 2 Bloombergs, 25 grand, that's it. No deals. And one of the main things I used Bloomberg for was through the instant messaging to talk to the brokers, because a lot of times you want to, when you're trading with these brokers, you want to have stuff in writing, right? Because if you get really busy, you could forget what you said, or but if you see it in writing, it's like, it just makes it clearer. So you just that's one of the things I did. And Wall Street too is very there's a lot of compliance. Like, the compliance officer is going to read all your emails, going to read your IBs. Who remembers the Quotron machine? I remember Quotrons. All right. So anyway, going back to this, right? It's just a basic principle of markets that when stocks get to support and they don't break it, they tend to bounce, and that's what happened here. So think about it. Think about this, right? This support, this line here, it's 118.50. This is a bunch of buyers. This is a bunch of investors who have placed their order close to this level or at this level. This is pretty precise here. All right. So when a market is going lower, like here, it's because there's not enough demand to absorb all of the supply. So sellers need to accept that they're going to get a discounted price. They're going to get a discount. They got to sell it at a little bit of a lower price. When we get to a support level, things change. All of a sudden, there's enough buyers that they can take in all the stock that the sellers have. So the sellers don't have to worry about the stock going down anymore. But what happens is people start thinking, oh, gee, it's stopped going down. It's at support. There's a lot of other buyers out there. So some of the buyers start to sense, oh, there are other buyers out there. And then they start to, I don't want to say panic, but they start to get anxious that their orders aren't going to be executed. They're going to say, like, I'm at 1850, but I'm afraid so-and-so is going to go to 119. So I'm going to go to 119.50. And then it kind of becomes this like snowballing effect where everyone kind of sees the price going higher and then they want to get out ahead of it. So when things get to support and they hold, they tend to rally. And it's the same thing with resistance, right? If we get to resistance and we don't get through, some of the sellers are going to start to get worried, like, oh, these other sellers are going to lower their prices, so I better lower my prices too. And it kind of, cascades. If Amazon misses today, Walmart could break support. Yeah, that's a good point. That's a good point. All right. Yeah. Well, we'll see. I guess. Well, I think of a lot of our people that were in this are day traders, so they're probably going to sell it towards the close. Actually, that's not true. Some of them bought it back here. Yeah. Well, that's a good thing to point out, Jeff. I appreciate that. Let's take a look at Amazon while we're at it. AMZN. I mean, we can see here. Let me get rid of this. Right? Like, look how clear support, clear resistance. All right. So say Amazon reports and it's bad, and it gets down to around here, this 102 level. That's when you start looking for a potential bounce, because it's getting to support. And a lot of times the market like over exaggerates things. In the morning, it might be down really big, but then people start to say, oh, we went through the numbers, they're not as bad as they seem, but maybe we should go in there and buy. So it's not a trade recommendation, but it's just something to watch. If we get down to this support and it doesn't break, meaning going below it, there's a good chance something like this happens again. I mean, yeah, so that's pretty clear. So that's the 102 level there. One of the themes, I can't believe I haven't mentioned this, because this is one of our kind of taglines, is in the class, we let the market tell us what to do. All right? We let the market tell us what to do. We don't come in with some kind of preconceived notion of, well, here's what I'm going to do today. We let the market tell us what to do. Well, now, for example, if Amazon reports and it's really bad and it gets down and it finds support and it starts to rally, that's the market telling us, hey, maybe you should come buy me, right? It's we don't have a preconceived notion. It's like we find our ideas throughout the day. Conversely, if it breaks this support, maybe it goes a lot lower, and so, but we don't want to buy it just because it falls to support. Generally, what we want to do is buy it after the reversal starts. You're not going to pay as high. You're going to have to pay a higher price, but the risk reward ratio is going to be much better. So most of the time when I'm recommending a trade, I tell the students to wait for the reversal to happen. Like, for example, here, right? Just because it got to a former resistance level, that's not enough to sell it, because sometimes resistance breaks and it could keep going higher. But when we saw this here, like this red line, this shows us that we're starting to reverse. We're reversing off the support. So this is where you would sell it. You're like, well, Mark, why would I sell it at 122 when I could have sold it at 125? And the answer is, you just get a better, you stack up the risk reward ratio is better if you wait for the reversal to start, because you don't want to sell it here and then watch it break out and move higher. And, it's obviously it's the same with our buys too, right? You want to wait for the reversal to actually start. So, if we get down here, you don't buy it until it starts to do something like that. And maybe you buy it here, maybe you buy it here or here. So, yeah. So I think some people have a kind of an issue with that at first, because a human being, they want to be right. They want to sell it at the very high and they want to buy it at the very low. Corporate worker. Oh, that's for Mark G. What's pretty cool is if the Bloomberg building in New York City. I mean, you walk in there and it's like the most like futuristic. You think you're in like a spaceship. Yeah, it's. Let me see here. Bloomberg building. Let's see if I just want to see if there's an image of what it looks like inside. A lot of images here. Yeah, like that. That's kind of like what it. That's part of it. Yeah, see, like that. Like you literally, you feel like you're in a spaceship. So Michael Bloomberg worked on a trading desk. I believe he was at Smith Barney. Not 100% sure. And he was the person who was responsible for telling all the traders what the news was. And that evolved into Bloomberg. And now the dude is worth, zillions of dollars. Thank you, Q Antum. Here's the thing, right? People want to be right. And what I tell the students or people that are learning about trading is the only metric that matters in terms of success is your brokerage account growing or is it getting smaller? And if it's growing, you're doing something right. Now, if you sit here and you second guess yourself all day and say, oh, let's go back to here. Like if you second guess yourself and say, oh, it got down to support at 102. Now it's rallying. I'm going to buy it at 106. was like, oh damn, I should have bought it at 102. I should have bought it at 102. You can't think like that. You can't be too concerned with being precise or being right. You are concerned with, hey, my account, my brokerage account gained 3% today. I mean, that would be a phenomenal day. If you can do 3% every day for the next year, you're not even going to believe how much money you could have. So I think it's, in a lot of ways, I think it's like some traders have, and I used to have this. You have, an Excel spreadsheet that's linked to the market with live prices and everything. And so you can see all the stocks on your watch list, like where they are, how far away from the target they are, and so forth. But you have a column that shows you what your capital is, like what it was in the morning and how much you've gained or lost. And if you just focus on that, it kind of makes it easier, in my opinion, to accept the fact that you're not always going to get the best price. So the famous money manager, Paul Tudor Jones, said, this is a pretty interesting quote. He said, "You're always going to buy things at the top. You're always going to sell things that go higher, and you're always going to buy things that go lower." So he's one of the great money managers, and if that's what he says, then that's true. Let's see here. Alrighty, so let me see if we got any more questions. So, why should you join the trading school? Well, because I think it will help you make money. This is really the main answer, but it will demystify a lot of the mystery. Demystify the mystery, or should I just say demystify? It'll demystify a lot of what you think goes on. You'll understand how Wall Street kind of like really works, as opposed to what a lot of people think how it works. And we keep it simple, right? We just focus on what are important price levels, what are the trends. Look at this here for Amazon. I mean, this is a little in hindsight here.
Right. Really quick here, Mark. Just want to give a shout out to Martin, our most recent member here that just signed up for the trading school. Everybody, welcome Marty in the chat.
Hey, thank you. All right, so we can see here, just these peak, like within pennies. So let me throw up a momentum indicator here. One of our classes is on momentum. And momentum is a measurement of how far something has moved in a given period of time. It's not the same as volatility. Something can be very volatile, but if at the end of the time period it ends up where it started at the same price, it's going to show neutral momentum. So momentum, every stock has like what you would call its typical, or it's historical trading range, and it spends most of its time in that range. If something gets aggressively sold and it gets below that range, we call that oversold. Or if something gets aggressively pushed down below its range, we call that oversold. And if something gets bought really aggressively and gets put up above its typical range, we call that overbought. Now, why is that important? The answer is things that are overbought or oversold tend to reverse. It's like a rubber band, right? Something gets stretched out and it tends to reverse. So these are two of the things that we learn about in the class here. I'm just going to try to make this a little easier to read. All right, so these are two ways that we can measure momentum. And this is called our Bollinger Band. Guy by the name of John Bollinger has credited with making them. Now, The red button or the red line on the top is 2 standard deviations above the 20-day moving average. The red line on the bottom is 2 standard deviations below the 20-day moving average. Now, why is that important? Well, according to statistics, at least this is what they tell me, because I'm not a statistician, that 95% of all trading should be within 2 standard deviations of the mean. So if a stock gets outside of this range, there's a good chance that it's going to reverse because it's gotten to an extreme. And this will bring buyers in the market because they're going to be anticipating a reversion to the mean. So there's a lot of trading models and systems and styles are based on this concept of reversion to the mean. So now this is especially the case when we get to a support or a resistance level. If something is oversold and it gets to support, there's a good chance it's going to bounce. If something is overbought and it gets to resistance, there's a good chance it's going to sell off. So let's look back here on Amazon, right? So Amazon gets up to, let's say here. So say it's October or last year. All right. And Amazon is going lower and you're thinking, oh, where should I buy it? Well, let's see. There was support down here and there was support here. So you tell yourself, well, if we get to support, I'll buy it. And here, well, let me rephrase that. If we get to support, I will watch it for a potential reversion. All right. Because again, we don't want to catch the fallen knife. We don't want to catch the fallen knife, right? So we want to wait for the reversal. So when we see something like this, something that is oversold, it's below this lower Bollinger Band. Remember, 95% of trading should be within these 2 bands. It's oversold and it gets to a level that had been support. We want to wait for the reversal. Maybe you buy it when we close back within the Bollinger Band. So that could be something to give you conviction that the reversal is actually going to happen and it doesn't break down like here. So this would be a good place to buy it. So say you bought it around 161, start to rally and you start to think, gee, where should I sell this? Oh, hey, the last time it got up to 187, there was resistance. There's a good chance there's going to be resistance there again. So we get up there and we're overbought or at resistance. This would be a good time to sell because overbought stocks that get to resistance tend to sell off. So you would have bought here and sold here just based on understanding the simple concept of what momentum is and understanding how some price levels are more important than others. So it doesn't really need to be that complicated. Our classes there's 8 classes. One is our philosophy. That's going to be on Monday. We talk about just the philosophy and the stuff I'm talking about now. The second class is our price levels. The third is about trends. Fourth is momentum. Although I want to combine trends and momentum, and I'm going to add a class on options because a lot of our students are interested in options. It's not going to be as in-depth as like Chris's classes, but just basic stuff. What's a call? What's a put? What are some possible strategies for trading them, so forth. All right, so that's a look at Amazon. Let's see what else is in the news here. Oh, Ford. All right, let's see what we can get from Ford. Their number looks really good. All right, so now Ford is a little bit overbought here, right? So this might be, I'm not talking long term now. I'm talking about from a trading point of view. All right, so let's look at that, right? Now we're overbought. We're above the Bollinger Band. And we're at a level that was resistance before. So if you're a trader, this would probably be a good place to take some profits if you're long. And then guess what? If it looks like the resistance is going to break and it keeps going higher, then you just jump back in. So a lot of times the stocks will make meaningful moves after they get to your targets, right? So let's just talk about this for a minute. Most of the time, your price target is going to probably be at a former support or former resistance level, right? Because we know that stocks tend to stop when they get to those levels. But because they're important levels, then it could make a big move afterwards, right? Like, in other words, you're selling it because you think there's a good chance it's going to reverse and go down. But maybe it breaks out and goes higher. Well, then you just say you can just jump back in and buy it. So that's kind of a trading mindset. You know, a lot of people, I guess it's just some kind of a psychological thing where if you, you buy or you sell something. You're welcome, Dark Matter and Battle Rap. We do talk about physics in the class sometimes, UFOs, dark matter, the expansion of the universe, Big Bang. But I think people kind of have this mindset. I guess it's just a typical human reaction where when you get into a position and when you get out of it, you tend to kind of just be like, all right, I don't want to look at this anymore. But that's not a good way to that's something that, just because something doesn't work out doesn't mean you got to hate it. It's a stock, it's an inanimate object, so you get down here and you say, I'm going to buy it, but it breaks the support and you get stopped out and you're like, damn, I got stopped out. But then it looks like it's going to go back higher. Well, then you just say, you forget that you got stopped out and you take your little loss and you jump back in and maybe it moves higher and you make up for it. So I guess part of being a good trader is you have to be kind of like nimble, yeah. If you just focus on here's the thing, right? If you are thinking about, am I right or am I wrong? You're going to drive yourself crazy. And then the whole concept of this, something gets to the target and then it breaks through and I'm going to jump back in type of an idea. Like if you think about stuff like that, you're going to drive yourself crazy. If you put yourself in the mindset of what can I do to increase the value of my brokerage account, all of a sudden it becomes a lot easier to do things like, all right, well, I sold it. Now it's moving higher. I'm just going to buy it back. So hopefully that is something you guys, yeah. So hopefully that's something that is helpful. Sorry, it sounds like there's some construction going on out on the road there. I don't know if you guys can hear that or not. So let's just take a look at like some random stock and just see if we can come up with some kind of insight on it. Let's see. How about Airbnb? I haven't looked at them in a while. A, B, and B. All right, now let's see what we could see here. We'll see some of our principles, some of our market principles here. All right, so we get outside of the bands and we reverse, right? That's oversold, overbought, oversold. We can see here we have a phenomena of a level that was support turns into resistance. See how this was support here? Actually, I'm going to probably put it right there. So support becomes resistance, right? So now we're a little bit overbought. Well, maybe we're probably not overbought. But you can almost look at like any chart and just see these principles in action here. The concept of momentum, the price level stuff, the trends. Let me just pick another random stock here. See if we could come up with the potential trading idea. Let's take a look at Tesla, actually. One of my brother's country club has a Tesla. I don't think I would ever get one, though. They're a nightmare if you have any kind of problems. No one can service them except for Tesla places. All right. So this is something that we talk about in our patterns class. I don't think I've mentioned that. Some patterns are valid and some patterns aren't. One of the patterns I think is valid is the ascending triangle pattern. And that's kind of what we have here. And the reason why they call it that is because this line is ascending. Now, when we look at these patterns, we have to think about, it's not reading tea leaves or, astrology or whatever. What does this tell us about the supply and demand dynamics that are occurring in this market? Well, this is a resistance line, 754. There's a lot of sellers up here, all right? Or there were a lot of sellers. I mean, I know this is hindsight, but this is a good example. So every time it got up around here, there's enough sell orders to fill all of the buys or to fill all of the demands. And we go lower, right? We get back up here and there's still a bunch of those sellers hanging out around 754. Go lower, get back up here. Still a lot of those sellers hanging out around 754, right? So basically from May through July, this big group of sellers was okay with just hanging out right around 754. At the same time, as time is going by, what's happening here? We're forming higher lows. We have this ascending line. This shows that the buyers are becoming more aggressive. They're willing to pay higher prices. All right. So here there were buyers. You can even say it started back here. So here there's the lows are 626, 641, 670, 690. So what is going on here? As time is passing, buyers are becoming more aggressive, meaning they're willing to pay higher prices. Meanwhile, you got the sellers who are just kind of chill and hanging out around here. So we have a combination of chill or complacent sellers, but buyers who are becoming more aggressive, meaning they're willing to pay higher prices. So whether it's the stock market or the housing market or the crypto market or whatever it is that you're trading or whatever market it is, when you have aggressive buyers and complacent sellers, it sets the stage for a move higher. And that's what happened here. So we got this breakout. These higher lows were an early indication that this resistance was going to break. All right, so that's the ascending triangle pattern. We don't look at too many patterns, but ascending triangles, descending triangles, I think there's some validity to them. All right, let's see here. We got some resistance up back here. This was an easy call back here to sell Tesla up here, and I'll tell you why. This particular indicator down here is it's called the relative strength index, right? It's a different way of measuring momentum. We saw the Bollinger Bands. If something exceeded the thresholds that was overbought or oversold, this is calculated in a different way. But anyway, I want you to look at this here. What am I looking for? Horizontal line. All right. Now I'm going to go take a little walk back in time here. All right. Still going all the way back to when Tesla started. This here was the most, by this measure, this was the most overbought this stock had ever been. So, when something reaches a historic extreme, it's time to pay attention. And, it could be a technical indicator. It could be a fundamental indicator. And then we see this here. These are like, this is what was happening here. People are probably watching Tesla. They're thinking, oh, should I buy it? My friend bought some. I think it's going to be, the stock's going to go higher, but I'm going to just kind of wait for a better price. Hopefully it comes down. I first looked at it at 700. Now it's at like 710, and people watch it go higher and higher and higher and higher. And finally they say, you know what? I'm sick of watching this thing go up. And they just go out there and they just buy it regardless of the price. And as a result, you get stuff like this happens. And it's almost like it's like a capitulation, but it's like a buying capitulation. It's not like a selling capitulation. So, and then we can see here, when we got back up there was resistance there again. All righty.
Really quick here, Mark. We got a question here from Tim asking if he is scalping or if he's trying to do swings, um, or just trade crypto. Would the class help him in that case if he's trying to do maybe different things like maybe even trade options? Right? Is this a class that can help people across the board? I guess
Oh
is what
yeah,
he's trying to get
definitely.
at.
Yeah, I mean these things apply to all markets, whether it's crypto, um, and as long as there's enough liquidity in the market, then yeah, I mean yeah, definitely. We got a lot of people that do that. And if you're a swing trader, or I mean, sorry, a scalper, this is the type of stuff that you want to be aware of, right? Because things move off of like important levels, right? If if yeah, like if you're one of the, in my opinion, one of the best trading strategies is if you're a really short-term trader to trade off of longer-term dynamics. All right. So let me say that again. If you're a swing trader, trade off of longer-term dynamics. Some people ask me, like, how far back should they look on their charts? And if they're only a day trader, why should I look back for a few months or whatever? Let me, you know what? I got a good example. I'm going to bring up CVS. And the answer is you should look back as, you know, as far as it takes. All right, I'm going to just bring up CVS here. This is something that happened in the class, which is pretty interesting. All right, let's see here. This is why you need to know where the long-term dynamics are, even if you're a short-term trader. All right, so this is CVS, the drugstore, right? There's pretty much one on every block in my town. July and August of 2015. We get up here, we hunt resistance, and we go lower, right? Let's fast forward here 7 years. This is a really good example of what we call market memory. The company reported earnings here, and that's what drove this higher. All right. Now, if you're a day trader or a scalper, it's probably pretty relevant to know where this longer term level is, because just say you bought it at just say you bought it at 110 and you tell yourself I'm going to sell it if it gets to 112. Well, there's a good chance it's not going to get to 112. So you would know here, all right, well, I'm going to buy it here and I'm going to sell it just under this resistance level at 111. So it's not as good as getting 112, but it keeps you from missing it. Things like this, right? Oversold and at support. So something's oversold and at support. You wait for the reversal to start and then you jump in. So yeah, that it would certainly help that. That's your style. And a lot of our students are scalpers and shorter term traders. You got any other questions, Rodrigo? You're muted if you're trying to talk. All right, I guess Rodrigo has stepped away. Let's give me 1 second. All right, so let's see now. Let me just kind of go back here and let's look at a couple things before I have to wrap things up in a bit. All right, so we look at commodities, right? And you can trade them with these ETFs. One of the things that told me that this GDP was going to be negative today, even though people were looking for a positive, is look at this big move lower in copper here, right? So to me, this is indicative of an economic slowdown. Copper is really widely used. It's used in pretty much everything: housing, automobiles. It's a really widely used. It's widely used. So a lot of people watch it to get some kind of indication as to what's going on in the economy. Now, I first started writing about inflation 2 years ago And the reason why is because of what I saw in going on in the copper markets. So this big thing here tells me that this is due to an economic slowdown. So that's why I wasn't surprised that we came in negative today. Carbon S, what's a good way to assess fair price? Well, I don't know. That's something we can talk about for a long time. It's not as simple as it might sound. You know, in a trading mindset. I don't know. Let me just bring up some stock here. I'll just bring up this one. Actually, no, I don't want to have a penny stock. All right, so I guess to use excess fair price, it's kind of an amorphous type thing because it depends on your style, right? To a trader, what's a fair price? Well, whatever someone's willing to sell it to you or buy it to you from at the current time. A fundamental manager might say, based on what I'm seeing in this industry, this company's fair price is $50. And I'll tell you how they kind of get to that. So let's go over here. I don't know why I'm using this one. It doesn't really make a difference. Actually, no, let's look at Ford. I think that would probably be a little bit better. All right, so this is the way a fundamental manager would kind of go about looking at this. A lot of what happens on Wall Street is due to comparisons, right? The analysts will compare a company to other companies that do the same thing. So here, if we look at Ford, wow, look at that. This is, well, you know what? Tesla probably throws us out of balance. But basically, just to kind of make it an easy way to think, right? We see here that Ford has an PE of 6.7. The industry average is 25. So a fundamental manager would say, oh, if this thing gets to fair value and it gets up to a PE that's in line with the average, how much would the stock go up? So in this case, that means the stock would go up by fourfold, right? I mean, it's a little more complicated than what I'm saying, but this is the type of thing that fundamental analysts look at. Let's see more. All right, yeah. So look at this. So Ford Motor common stock. So some of these probably aren't good comparisons, but just for the educational purposes, we could go look at the price to earnings ratio. So if there's not a price to earnings ratio, they're not making any money. But that's a way of a fundamental manager would think about the fair value of something. Well, if the market is misvaluing this thing, if it's in line with if it gets to be in line with the industry average, this is what the price of the stock would be. So those are what we would call value managers or fundamental managers, or Graham and Dodd. You might have heard. They're the classic ones. Let's see. All right, yeah. So SPY's getting pretty close to our target here. All right, so would have bought on this breakout, and now we're getting close to resistance. Hold on just 1 second, guys. I just got to do something here. Oh, sorry about that. I didn't realize I was muted. Yeah, so that's yeah, I mean there's a lot of different ways to look at that. But I think those are, in the trading mindset, something's only worth what someone's willing to pay you for it. The fundamental mindset, they look at if this was in line with the industry averages, what would the price be? So something could be overvalued or undervalued. Let me see. All right. I'm sorry about that. I'm going to have to get going pretty soon. I got some family stuff, family drama to deal with, unfortunately. So tomorrow morning is our Friday class where we pretty much just talk about anything. Monday through Thursday, we do our lessons. But then on Friday, it's pretty much open just to review what happened over the course of the week. People have questions. Today's lesson is how to build trading models and how to think about investment strategies. And a lot of that comes from some of these indicators here.
Right. Good. Yeah. And there's the thing, Mark. You actually teach a lot more than that, right? It's a lot of a deeper session with the members there in the school. So we've been here for quite some time here, Mark. Do you have any closing remarks on your end on the markets and why the members here should join the school here? We have the link in the chat for those that already want to join here.
Well, because the way to learn is to be involved with what we do every day, right? Because the way the market acts, the market acts different at different times. Like, for example, a market at a top is going to act different than a market at a bottom. And I like the analogy of boxing, right? Or it could really be any sport. But just say you're welcome, corporate worker. Say you want to be a boxer, okay? You could work out, you could run, you could work on the heavy bag, you can lift weights, you could do this, you could do that. Until you actually get into the ring and actually box with someone else, you don't really know kind of what it's all about, right? And you can watch a YouTube video or you can read a book about technical analysis and trading, but until you actually see how it works at different times and the market goes through different cycles, you're not going to really understand a lot of what's going on. Like, for example, there's things like action, right? If a market is towards a bottom and a company reports bad earnings, but the stocks will tend to go up even though the earnings are bad. That's a characteristic of a market bottom. A characteristic of a market top, a company could report good earnings and the stock could go down, right? So it's a way you can learn about trading and technical analysis and how Wall Street works, and then learn how to apply it in real time and with common sense and common sense and simplicity. It doesn't need to be that hard.
All right. Well, there you go. Thanks a lot, Mark Putrino, Chief Educator at the Benzinga Trading School. And for all the folks that joined, keep in mind we do have a class this week. I mean, classes are Monday to Friday. Thanks a lot, Mark, for being here. I'll show them the school here for a quick minute and just to show all the folks that just joined.
Okay, cool. Thanks, Rodrigo. And thank you, everyone. And thank you, PDX. I see you there. Okay, guys, I'm going to sign off. I will see you all hopefully tomorrow morning.
All right, everybody. That's Mark Putrino. As you can see him, he is the educator there at the trading school. There's a lot of material being discussed there. If you go to the dashboard here for all you guys that joined, in the header, you're going to find everything there. So your dashboard will pretty much show you the schedule: Tuesday, Wednesday, Thursday, Friday, your whole week ahead, right? So you can plan. And then whenever you do have the live classes, which is Monday to Thursday, 7 to 9 a.m. Eastern, and then 12 to 1, and then Friday is 7 to 9. Eastern as well. You just click live here. It takes you to the live class, right? You can hide this chart. You can hide this chat room. This, by the way, this chat room is basically the students of the trading school, but it's for that particular chapter. So you can see right here, this is Introduction and Philosophy to Capital Markets. So this is chapter 1 actually. You can see there's 4 people right now that are on this chat here. I'm not sure what doing what, but there's a lot of good material being discussed. This is the chat of the class of the day. So some people do want to sometimes just stick around this chat just so that they can go over the class and over the material of the class with the recording at the same time. With the live session, right, or the recording, whichever one. Now, then you have video library. This is where you find all of the recordings of all the chapters, even if you miss it. If you're not able to attend for any reason, you can always find the recordings here, and you can watch them live. Not live, but you can watch them whenever you have the time, right? Very important. Maybe you do want to just kind of brush up on a couple concepts or any particular chapter there. The live trading rooms. This is where you're going to have a lot of fun here. You're going to have Mark's trade ideas, very important. Talking about Walmart. I mean, a lot of people, we're talking about that trade. Questions for Mark. You have that as well. So a dedicated chat room for questions, dedicated chat room so that you have all the resources here on our end that we can give you so that you can all take max advantage, max value of Mark Putrino and the trading school with this technology. So general discussions, class materials, class files. Okay, these are quizzes. These are comprehensive quizzes per each chapter created by Mark Putrino to basically help you find those weak and strong points so that you know where to put your time into, right? And all that stuff. You can also put sound alerts here. All you have to do is click on that bell. If the bells turn yellow, that means that you do have them on. If they're not, then they're not on. These are sound alerts, right? That you can have them having this chat room open. And the other thing you have is Benzinga Pro. This is included with that as well. So you can pretty much find stocks here, whatever it is that you're looking at. You can use it to do charting, technical analysis, all that sort of stuff. If you're looking at any sort of chart, whatever it is that you're trying to trade, whatever strategy you're using, you can always chart this stuff. Check the news. More importantly, Benzinga is financial media. Keep that in mind. So we do have a lot of technology there a lot of relationships really that Benzinga has that this kind of comes together into one. So for those that have only maybe used Benzinga, you guys probably know you're pretty much spoiled with Benzinga Pro and the school because Pro is a monster machine, everything you can do with it if you know how to use it. So, and someone's asking about the packages. So the link that we do have on the description on the video, it's $4.97 for every 3 months. So like a semester. If anybody does want to do the year, it's $14.97. So you save like $500. And if anybody wants to do a lifetime, it's $5,000. So basically like 3 years of the subscription. So, but this is only available until midnight, right? So at least the later two, the $14.97, right? And the other one. So you can use Pro for whatever it is that you're looking at. Scanners. Right here on the top left, you pretty much have all of the tools that you need. This is a scanner that a lot of people use to day trade or scalp or whatever it is. You can even do it for longer term trades because you do have a period time frame. You can set it up by custom dates: 1 year, 6 months, 3 months, an hour, 5 minutes, pre-market, aftermarket. It's the only scanner that does this. This is the source of the information that we have. You might see. You might see scanners that scan from 9 to 4, but our scanner is pre-market, so from 4 in the morning till 9:30, and after hours from 4 p.m. till 8 p.m. Eastern. So you really don't miss out on a single second when it comes to trading. Opportunities out there, right? You just need to have the tools to look at them, right? It's like marketing, like if you might have something good, but if people are not watching, they can't get it because they're just simply not watching. So as a trader, you can get good trades, but if you're not, quote unquote watching, right? Because, maybe you don't have the right tools, or maybe you just started trading. You're not aware that what you can get with Benzinga Pro or with the school, right? It's cool. No worries. But if you've seen this, then, I definitely would take advantage of it. It definitely helped, hundreds of traders, including myself, with so much material that you cover here. So All right, folks. So I'm going to leave my contact there. If anybody does have questions, reach out. Thanks a lot for being here. And all the new guys that joined, welcome. We're going to see you in the class tomorrow at 7 to 9. And shout out to all the members here. What's up, Shauna? We got Jan. I don't know if I'm saying that right. Gene, Buttery Lobster, PD4, corporate worker. Bunch of familiar faces here. All right, folks. So big shout out. Thanks a lot for watching this and, hanging out with Mark and me here. If you do want to learn more about Mark and the trading school and all that stuff, give this a shot. You have a 7-day money back guarantee. We're actually, so anything else that you need, folks, reach out. Thanks a lot. And we'll see you guys in the trading school.